We're going to be moving now to the panel and fireside chat portion. And I'm really, really excited about this first panel, which is digital securities as an asset class. So basically what we're going to be looking at is what is a basic taxonomy of all of the different types of crypto assets that you see out there today? How are people making smart investment allocations, right? And how are funds specifically as well structuring themselves to take advantage of this new category? And then finally, how that kind of fits into more traditional portfolio theory and construction. So our speakers and moderator are going to explain this far better than I can. So I'm now going to invite all of them up to the stage. Please welcome our moderators and panelists. Thanks, guys.
You know the day destroys the night, night divides the day. Try to run, try to hide, break on through to the other side. Break on through to the other side. Break on through to the other side, yeah.
All right. Good morning, everyone. Day 3 to 8 of Blockchain Week, depending on how many of these events you've gone to, but this is definitely a good one, much different flavor than I think you might have gotten if you've been to any of the other events. My name is Ryan Selkis. I'm the founder and CEO of Messari. We're a crypto asset data and research company. And I'm going to allow my distinguished panelists to do a quick 30 seconds on themselves to set the stage. But maybe for a starting point and just to piggyback off of that intro, we're going to talk and try to set the stage for the rest of the event. So how do we think about cryptocurrencies as part of an investment portfolio? How do we think about all of these tokens that came to prominence in 2017? Is there anything real there? Is there anything worth paying attention to? And then, of course, we're going to talk about digital securities, which is maybe a little bit more comfortable for institutional investors and still very, very early in terms of its build out in the crypto industry right now. I tend to think about those three types of assets as a barbell. Currencies, super interesting. There's going to be decentralized stores of value like Bitcoin and Ethereum and Zcash and bona fide currencies that can ultimately replace some fiat currencies, maybe not the dollar to start, but assets in emerging economies, for instance. On the other extreme, there's crypto securities. We know it's a large legacy market, but the question is how much incremental value is unlocked by blockchain technology? How soon are digital securities in a crypto context really going to be coming into prominence? And then there's that middle layer, which is very murky, which we might touch on a bit if time permits. But before we get into all that, maybe a 30-second intro from Roy. We'll start with you, and then we'll go down the line.
Thanks, Ryan. My name is Roy Niederhofer. I'm the president and founder of RG Niederhofer Capital Management. We are a hedge fund that started in the futures space about 27 years ago, and I've been doing that for my whole career. After the global financial crisis, I was very concerned that QE was going to lead to a lot of money printing by central banks, and I read about this new thing called Bitcoin in 2012 and began getting interested in that, and by 2017 we ended up with one of our funds being a way for crypto holders to use their crypto to make more crypto by investing in alternatives, but not alternatives in the crypto space, but alternatives outside the crypto space. So I guess you could say what I do, among other things, is run a futures fund, creating all different assets outside the crypto world that allows crypto holders to make more of their crypto, thus being, I think, one of the first true alternative investment providers in the crypto space, which, as you know, already has stocks, we call those ICOs, and bonds, securitized lending, like what we heard before.
Cool. I'm Travis Kling, Chief Investment Officer of Ikigai Asset Management. We're a crypto asset hedge fund based out of Los Angeles. I come from the traditional hedge fund investing background. Most recently, I was a portfolio manager at Point72. I had a career in energy investing before founding Ikigai. Fell down the proverbial crypto rabbit hole in the summer of 2017 and convinced myself that this was going to be the most significant technological innovation since the internet the first time around. and as such was likely to be the most significant investment opportunity of a generation. So I left Point72 in December of 17 to pursue crypto investing full time. Spent basically 2018 building Ikigai, and we just launched in January of this year.
Awesome. My name is John Nance. I'm the president and CIO at Dealbox. Just a little bit of background on myself. I started off with a career in derivatives trading, moved into 8 years of financial advising, and to Travis's point about crypto rabbit holes, I started down that in about 2013, and the next logical progression in that evolution was to move into kind of capital markets consulting with regard to digital assets. And so at Dealbox, we're structured as a fintech merchant bank and capital markets consulting group that focuses on helping issuers package up offerings and build creative structures around those offerings, specifically related to security tokens and digital securities.
Morning, everyone. Dmitry Tokarev. I'm the CEO of Copper. We provide custody and prime brokerage services. We're based out of London. My background, I was a quant in a hedge fund, started off as a quant in a hedge fund, and been always pretty much sitting in the back room, pressing keys on the keyboard, and realized that the infrastructure within the traditional financial services sector is basically eating up a lot of profit margins within the financial services industry. And blockchain, as a decentralized, most secure database, solves a lot of problem of databases communication there. So we started building infrastructure, and very excited being part of the journey of creating the Rails for Financial Services 2.0.
So why don't we start off with Bitcoin? Because we've just seen a massive rally since the beginning of the year. There's always the proverbial institutions are coming mantra that I've heard at least for the last 5 years, and it's always like 6 to 12 months away. Is this time different, number one, and number two, has enough of the foundational infrastructure been built where your clients, your partners are starting to ask more about bona fide digital currencies first and foremost, and not whether they should make long directional bets, but at least have some allocation in what some analysts call an uncorrelated asset?
You want to start there?
Sure. I think we're already starting to see tremendous interest from institutions in the digital asset space, and some of them have recognized that digital currencies, and I guess I could say cryptocurrencies rather than stable coins at the moment, represent a brand new asset class. When I talk to people who have kind of a macroeconomic background and look at the world in the way that hedge funds do often, and look at central banking and look at people that are serious candidates to lead the United States coming forward who are espousing multi-trillion-dollar deficits, who are talking about Social Security, Medicare, that's going to lead to hundreds of trillions of dollars in debt that we need to service, in obligations that we need to service, suddenly Bitcoin starts to get pretty interesting to them. And the reason that it's interesting is it's the first time in human history that there's ever been an asset class that allows you to make more of it while having a fixed supply of it. So if you have gold, and you have your gold in a vault, or you have your gold in a hole in the ground, and you're standing there with a shotgun over it protecting it, it's not going to turn into more gold. If you have a Picasso, it's not going to turn into 1.05 Picassos by itself. But cryptocurrencies can do that, and the way they do that is you can make more, obviously, by investing your crypto in interesting ICOs, but you can also lend it out to people. I think many of you have experienced or are aware of the growing lending market. What's going to happen is something we just heard about, but in the crypto space as well, which is securitization of these assets, and suddenly you're going to be able to make, as many already are, 1, 2, 3, 5%, depending on the term, depending on the counterparty, in a securitized Bitcoin bond. And now suddenly, you have stocks and bonds, and as I mentioned, we have alternatives, and you've got a fully fledged asset class, but unlike every fiat currency, it's got a fixed supply, and there will never be the vice that every single currency ever issued by any issuing authority in the history of human civilization has. And it's something we're about to do in the United States. The government is incentivized to issue too much of it, debase it, and destroy its value. It used to be that for a penny you could get a whole meal. Now, of course, it's maybe $10. We've had 99.9% devaluation in the US dollar. Bitcoin is the first time that you can get fiat-like returns in a fixed asset space. And that is getting institutional interest. And I believe when people start looking at not just the asset transfer use case of Bitcoin, which is another thing that got me interested back in the day, but the stability plus return aspect for financial investors, then we start to see, and now I'm going to say something that is going to be 95% likely to be completely incorrect, and you're going to look back and say, remember that guy Niederhofer who sat on this panel and said this? What an idiot he turned out to be. I think Bitcoin gets to reserve currency market cap. I am beyond 100,000. I think we're going to look at prices in the millions because there's a good chance, non-zero chance, that this occurs. And when it does, you'll talk about the yen, the dollar, the euro, the yuan, and Bitcoin as reserve assets.
I was just going to say, I think it's important to note that if it hadn't have been for quantitative easing, Bitcoin would be a science experiment in a bunch of nerds' closets. And the big world wouldn't care that much. Thank God for the nerds, by the way, because they built all this stuff. So deeply appreciative of that. The rally in 2017 happened when the Fed was trying to starting to try and end the largest monetary experiment in human history. And then risk assets across the board had a very tough year in 2018. And as late as mid-December 17, Jay Powell was still using this term autopilot to roll off the balance sheet and raise interest rates, which the market really didn't like. Trump didn't like it at all either. Started chastising the Fed on Twitter to stop doing that, and it worked, right? And in the end of January, you had this complete capitulation by the Fed with their stance on tightening. And then you had the ECB and BOJ and PBOC and Reserve Bank of Australia and Canada and New Zealand just cut rates, and that all happened right in lockstep. And so the central bankers around the world have now, I think, shown their cards in the sense that there is no plan to end the largest monetary experiment in human history. And on the fiscal policy side, it looks as bad, if not worse. I mean, modern monetary theory, if you've dug into that a little bit, that's really scary stuff, and it's getting traction. And Bitcoin is an insurance policy against that. It's a hedge against that.
Right. So, and I'm gonna pivot the conversation a little bit. So I'm gonna take the leap of faith that folks in the audience believe some version of that, or at least the potential for that version. And I really like my panels to be nice and spicy and controversial. So I want to get back to practically speaking. Say you get institutional investors to buy into that, or at least some person to buy into that, make the case to their board, to their LPs. We should have an allocation here. How far away is that from going into practice? Because we know that there's been data integrity issues, that there's been custody issues and regulatory issues that have prevented that inflow much more than the macro case, which I think you guys laid out well, but many in the audience might already agree with. So practically speaking, when do we start seeing these entities move in, or are they already?
Yeah, no, so with that perfect framing, something Dimitri and I were talking about is that once you have the background that Travis and Roy just so eloquently stated, what you're really looking at from a portfolio construction standpoint is further diversification, right? Building a portfolio that has assets inherent to it that's going to zig when the rest of your assets are zagging, right? And yes, the data sets are only 10 years old for Bitcoin, but in another 10 years, we start to have 20-year data sets, right? And how long is it until you wait to do that? So to Ryan's point around the infrastructure, I think that we're seeing a lot of really great solutions, and I'll let Dimitri kind of comment on that, but for us at DealBox and kind of looking at like the top-down integration into asset managers, RIAs, wirehouses, hedge funds, really what we want to focus on is the issuance technology in the way of distribution as well as performance reporting capabilities. How do I pull this into my firm's performance reporting? Whether you report through a Tamarack, Orion, Black Diamond, what have you, these types of integrations, and then custody solutions, which I'll let Dimitri touch on.
Yeah, to answer the question, when are we going to see that? First of all, one particular client type that just started emerging in the last 2 months in Europe, the funds called UCITS funds. I don't know if you guys are familiar or you have something similar in the US. These guys basically have about 7 to 8% trash bucket, as they call it, which they can basically do anything with. And these guys start to consider to do that allocation like in Bitcoin. They can do anything with private properties, anything like that. And those funds, as far as I know, are available to retail audience as well. So that's where pension funds can do their allocations and things like that. So that particular client type is emerging, which is quite interesting. But from the service provider infrastructure and general infrastructure standpoint, what we're seeing is basically exactly the same movie that we saw 20, 30 years ago when hedge funds were created. Started coming up, smart guys coming out of Ivy League schools managing family portfolio. Then institutional guys come in and say, we're going to give you 50 million, but you got to use custodian, you got to use prime broker, and there is no self-administration. So please build that within your framework, and then we do an allocation for you. So everyone who we work with today, our clients and the funds, all of them basically have prospectus drafted by Schulte or whoever. They have administrator, they have regulatory hosting umbrella, and all of those things basically allow them already to be in this space. However, we're seeing that not as part of the portfolio construction, like in the large institution, but as a different institution on its own, splitting off and studying something.
I think one of the ways to see this path is to think back to conferences you might have been at 1 and 2 years ago. And what was the custody situation 2 years ago? What was the exchange situation 2 years ago? If there was a $800,000 exchange hack in 2017, Bitcoin would go down 15%. We just had a huge hack at Binance, and it went up. It didn't go down at all. And the reason is that the market has matured, and they recognize that Binance has competed by having a reserve fund to handle exactly this if they have a soft wallet hack. We have Gemini, look how far they've come. We have Fidelity with institutional custody, BitGo, and you guys. We've gone from the bury your Bitcoin in the ground with a shotgun protecting it to now people have safes that are made of really thick steel. And it's going to get even better every year until we have the same types of protection. I think a product that we'll see eventually is a way to get return on your crypto from insuring other people's crypto, a syndicated, decentralized insurance policy that'll maybe cost 0.5 or 1% a year, and it'll be like FDIC, and no one will even give a second thought because your crypto is insured. So all of these things are happening, and where we were 2 years ago to now, there's no question for an institution coming in, it's a vastly different world, and next year we're going to be sitting here and we'll think, wow, UNC and Stanford, they're buying 3% of their endowment worth of Bitcoin. Holy cow, that's fantastic. And that's when we start to see 5- and 6-digit prices in these things.
And are there any emerging markets investors in here? Like people that have experience investing in, I don't know, brick equities in the mid-2000s or something like that? Yeah, I mean, any new emerging asset class like that goes through these growing pains and a maturation process. And if you talk to investors that are active investors at the beginning of these new asset classes, there's just hiccups, and it seems a little fast and loose relative to traditional asset classes, but and there's risk associated with that. I don't want people to think there's not any risk associated with that. But as an investor, you're sitting there, looking at the potential for risk-adjusted returns, and I mean, we're all a little biased up here, but we think they're pretty compelling, even in light of some of these early-stage growing pains that are getting worked through right now.
I actually wanted to make a point about stable coins and why there's kind of the same risk in stable coins that there is in an emerging market pegged currency. Pegged currency, of course, is something that's the same as the US dollar, but it's issued by Singapore or Hong Kong or something like that. And the risk is that the peg breaks. So imagine that you've got a diamond-backed stablecoin, and you bought it thinking, well, these guys here's their audited supply of diamonds, and then someone says, well, wait a minute, kind of like what happened to Tether. Do we believe that those diamonds really exist? And now there's a run on the stable currency. And the question is, why is that more valuable than the actual thing? Why not just put your money in diamonds? That's not that hard. Put your money in gold. Well, what about a dollar stable coin? What could happen to a dollar stable coin? It's fixed to the US dollar. It's a fantastic thing to have. What can happen is negative interest rates can happen. We've started to see it in Sweden, where you basically can't use cash anymore. If the Fed issues a dollar-backed stablecoin and they want to have negative interest rates, you know what they do? They ban cash, so you can't put your money under your mattress, and you got to have your Fed coin in your cell phone wallet. But guess what? They can take 1 or 2% of that Fed coin supply away from you because they're issuing it. So there's an enormous risk in central bank issued stable coins as well. And what needs the alternative, of course, is a fluctuating stable coin, a fluctuating cryptocurrency like a Bitcoin that will be an alternative to the prospects of all of this. And it's yet another reason why a fluctuating, volatile at the moment, crypto is a very interesting investment when everything else is heading down the overprinting, yet also potentially negative interest rate. We're going to take your cash away from you, which is happening in Europe already.
I think that's a good summary of stablecoins, all of the risk, none of the upside. Does anything else matter aside from Bitcoin right now from an institutional standpoint, John?
Yeah, no, I'd love to touch on that. Thank you. So aside from cryptocurrency for a second, right, we're talking about digital assets as a whole. So as far as defining nomenclature goes, right, you can look at digital assets as being a breakdown of tokenized securities, venture funds, private equity, inclusive of cryptocurrency, stable coins, if people have invested in ICOs, what have you, right? So I think it's important to understand that framework first. And that being said, in our eyes at DealBox, one of the biggest advantages of kind of the tokenized version of private equity is really enabling secondary markets for private company shares. This is something that major businesses have been built on, right? Companies like SharesPost, right, which is one of the world leaders in secondary markets for private company shares. What happens if you're an early stage investor in a company in a Series B round and you want to get some liquidity before, you know, the company goes IPO? Well, you have to undergo a Rule 144 transaction, find a suitable buyer, go through a diligence process, and even if you have the capital and are ready to do the transaction, it can take up to 6 months to do these things, right? So creating tokenized versions of private equity investments and early stage ventures is really the technology that's enabling what these great businesses that have been operating for over a decade have been trying to achieve and have been doing so, but it's improvements in efficiency, right? So when you're thinking about it back again from a portfolio construction standpoint, the way we like to look at it is all of these things should be fitting inside your alternatives bucket when you're building these portfolios, and then within the digital asset sleeve, you have your breakdown of your tokenized venture, private equity, hedge funds, cryptocurrency, ICOs, and things of that nature. So away from Bitcoin and crypto, it is important to realize that when we talk about digital securities, really basically we're just talking about the enhancements around technology and efficiencies in markets that have existed for 10, 20 years at this point, right? So that's the way we look at it.
This is the whole purpose of the panel, right? You know, practically speaking, can everybody just tune out on everything except for Bitcoin for the next couple of years until the rest of the infrastructure is built? Because I don't know what the marginal improvements are for tokenizing, you know, an apartment building, because you've got liquidity issues, for instance. So, like, I think it's a worthwhile question. Are we just too early to talk about any other part of the barbell than the one that we spent the first 20 minutes on? Or we can, you know, make the case the next 15, 20 minutes on why that's wrong.
On John's point, with regards to the tokenized securities particularly, so first of all, why is it important? Why blockchain matters in financial services? Because I think a lot of people kind of like dismiss that argument, saying like, just do it regularly, just go and do it like, you know, IPO or something like this. You need to kind of look what's happening in the back office and within financial services organizations. Like, that's where I spent my entire career. And it's not like, you know, all nice and shiny there. Basically, what happens is, for example, it's a massive problem which all comes down to communication within databases. Every single organization, custodians, prime brokers, they will have their own databases. And will be service providers servicing those databases, IT integrators, that we're going to charge you, you know, $100,000 to change the color of a button or for a new patch or something like this. Most of those technologies have been built in 70s and 80s. Highest paying profession there is the engineers that code in COBOL. It's the syntax developed in the military in the US in the 70s, basically. It's the highest, basically, contractor's job now in Germany, because all that infrastructure is based on that. So what happens there is, for example, when it comes to securities, like, you know, how the settlements happen, for example, you would have a bank, both of these banks will have custodians. And so then you basically create a Swift message, like an MT500 message of some sort, and then, God forbid, somebody misses a comma. 4 people trying to, for half of the week, figure out how to settle this and where it needs to be. So all of these databases are updated. So we are quite early, but in mathematical expectation, we would expect that all this information will be readable from the blockchain itself, basically. So every single organization doesn't have to maintain their own databases, or at least they'll be able to sync up the database instantaneously because there is a golden source of truth, basically.
So if I'm understanding you correctly, there's a two-part answer to that question. One is, if you are an originator or an investment bank, you should be paying attention to this for back office purposes.
Yeah.
My question was more along the lines of, from an investment standpoint, does any of this matter yet? Or are these going to be experiments where the investors don't really care if this is a crypto security, as long as someone else is doing the custody and back office work? You can do it the old way, you can do it the new, save your bips, as long as I'm getting the same product.
So I'd like to propose, just for having an interesting conversation, the complete opposite view, which is digital assets on a blockchain is actually a subset of all blockchain-based technology, is not a transformational, innovation. It's maybe like the difference between
It's evolutionary.
Well, it's like
it's not revolutionary. It's evolutionary.
It's like a hierarchical. Remember a DBase, a hierarchical database, and then you have SQL and relational databases. Well, I mean, how many people actually experienced that change and said, this is a fantastic innovation? Yet everything we do uses relational databases that happen at the moment to be centralized. Do we need a Uber? Do we need a Spotify that's decentralized? I actually think the market works pretty well. I've been trading it for 25 years, and stocks and bonds kind of work okay. And yeah, there are ways to innovate.
A decentralized Uber might actually make more money.
It might make more money, but would that really change our experience of Uber? Do we really need it? And I don't want to pose, it's kind of a softball because I know you know the answers.
There's a bunch of different use cases for distributed ledger technology. The tokenized securities and private permission blockchains, the stuff that JP Morgan is working on, like this is evolution for Wall Street's back office. And eventually all stocks and bonds are going to be digital assets because that just makes complete sense. And I don't know how long it's going to take. I don't really care all that much. And it's amazing that Morgan Stanley is going to save 150 bips on their SG&A cost in Q3 2021. But another whole other set of use cases for distributed ledger technology is in this new asset class, crypto assets, and there's many different sort of subsectors within that look kind of like the S&P 500. To get back to Ryan's original question, money is the killer app for distributed ledger technology right now, and you need to understand that for each specific use case for crypto assets, subsectors, if you will, how ready is the technology for the world, and how ready is the world for the technology? Those are kind of two different sides of or two different directions of the same street. And specifically for the use case of money, the tech is about ready for the world. And in the context of what's going on with central banks and governments, it's getting increasingly more apparent that the world is ready for a non-sovereign form of money, and that's today.
It might be unfair to pose the question because I think it's, Bitcoin has an unfair advantage of being new and novel and sexy, and it's gone from 0 to 100 billion plus in value. And if you juxtapose that with digital securities that sit on a blockchain and save all these back office costs, not very, maybe there's a few people in the audience that are really excited about that because it's tied to their jobs. Are there other types of security-like instruments that are unique and could be unlocked and created using distributed ledger technology and actual crypto, where it's global, it's permissionless, it crosses borders, it might not necessarily fit into regulatory structures right now, or is it still, it's either currency or digital securities? Is there any middle ground there where there's new types of synthetics that you guys are taking a look at that might be the next thing on the radar for institutions?
Yeah, I mean, that's an interesting question. I don't know about the midpoint between a cryptocurrency and some other type of traditional security, but the way that I look at it is access to offering structure, right? So you can do a lot of cool things around the programmability of a tokenized security that you can't necessarily do from an offering construction standpoint inside of a venture capital office as you're crafting the deal terms for a specific allocation, right? So like one example would be profit sharing agreements that have convertibility to equity components, right? We structure a lot of offerings this way. So you can't really, in an efficient way anyways, fractionalize the distribution of revenues or profits or royalties to 100 or 1,000 investors under traditional frameworks with paperwork, right? You have to do this in some sort of tokenized version and then allow that to trade, essentially. Now, to directly answer your question, though, about where that midpoint is between like a currency and a security, I'm not really sure. Maybe someone else wants to take that.
I mean, stable coins. and I think it's important. How many people have been following this Bitfinex situation? People following this pretty closely? At the end of the day, what the main takeaway with all that was is that there is tremendous demand for an unregulated stablecoin in the world. And that in demand, if there's 100 cents on the dollar, there's a lot of demand for it. If there's 74 cents on the dollar, there's a lot of demand for it. There's a lot of demand for an unregulated stablecoin. And that's for a number of different reasons, not least of which is Chinese capital flight. But these are just going to be the types of things that as we move forward in this asset class are going to be just part of the conversation. So, and it is global.
I think we actually have seen some pretty interesting innovations in that, the space in between. And if you take something like Augur, or essentially a smart contract that's based on a decentralized contract that is based on an objective event, and then something happens. So you could have, let's say Binance wants to syndicate their risk of insurance. They say, okay, well, here's our smart wallet, and we say that we're going to keep X balance in our hot wallet because we need that to be a viable exchange. But we want you all in the audience to take the other side of that bet, that if that balance ever gets below a certain amount, then you're going to be responsible for that risk. And maybe you'd have to get paid something to do that. You can do that with essentially with smart contracts. So I think that represents the middle region. But it's almost like saying, on the other side of this question, what's the difference between a bond and the US dollar? You know, it sort of lives on top of the US dollar, and everything that exists in the fiat world can exist in the crypto world in a decentralized form, and that's what makes it really interesting. And the fact that there can be an alternative value for a fixed supply version versus a fiat version where AOC can say, well, wait a minute, it doesn't matter how big a deficit, we're going to print $5 trillion of US dollars, and it doesn't matter. Well, maybe it does, and if you believe it does, you want to be investing in Bitcoin bonds and not US bonds.
Let's talk about maybe arguably the institutional imperative to start getting more deeply involved in these unregulated or murky markets. By the back of my envelope math, Binance, Coinbase, OKX, BitMEX, Wobi, all billion-dollar revenue businesses, at least on an annualized basis, if not full calendar year 2017 during the last run. That could be a blip compared to the next cycle if institutions do start piling in. NASDAQ made $4 billion in revenue last year. Not that far removed, right? So at what point do the exchanges, do the investment banks start to look at this much more closely and figure out how to move aggressively into the space, even amidst some of the regulatory challenges that they face and some of the traditional hesitations that they've experienced to dip their toe in the water?
I mean, what generally we're seeing on the markets is that the biggest opportunity for investors are in those unregulated exchanges like BitMEX and like Bitfinex, and that are based somewhere in the islands, etc. And they trade there predominantly because they offer them interesting tools. So the tools bit is something which is from the bank standpoint that they can really help with on exchanges that are based like here or regulated, or that are the ones that are launching. And these tools are essential basically to the point that I was making earlier as well, like things like margin, funding, lending, borrowing. When it comes to PB's business, for example, what's going to happen with collateral rehypothecation, for example. what if the equities, if it's an equity, for example, later it's been lent, what happened on the ex-div date? Or for example, with bonds, and if there is a repo, and not to repeat the same mistakes like Drysdale Securities and Chase did, I think, like 30 years ago, for example, when they were, buying at the clean price without a accrued coupon taken into account because it was like a 12.5%. So all of those things, I don't think we will be able to do that without traditional institutions getting involved and sharing that knowledge. And basically, so I think the ones that will collaborate in here and will build that together, basically will win the game. And the ones which are offshore will slowly start kind of like lose that advantage that they have today due to the fact basically that it will be better alternatives on a regulated ground.
Right now in the crypto landscape, you've got one foot pretty firmly in the sort of old world crypto, like unregulated, fast and loose, some kind of gray area situations. BitMEX is domiciled in the Seychelles and does some questionable things, and there's a bunch of wash trading on some other exchanges, and people aren't sure how to think about that. And then the other foot is firmly moving towards growing up and being an adult, and Fidelity, and a future that is traded on the CME, and a future that's traded on Bakkt and NASDAQ, and having institutional grade third-party custodians, and not getting hacked on Cryptopia. And so there's this really interesting just kind of juxtaposition right now of like the old world and the new world, and the old world has not let go of its grip on this asset class yet at all, and price discovery. BitMEX is supposed to be a perpetual swap that tracks the spot physical price of BTC, but there's more notional value that's traded on BitMEX than all of the spot exchanges combined. And so price discovery happens on this place that people aren't exactly sure what it is that you're trading, because it's just as we keep going forward through time, there's going to be sort of less and less of the old world, immature, less regulated, more questionable, more gray stuff, and more the legitimacy. And again, that just goes back to my point of this is an emerging asset class that's going through a maturation process.
By the way, that actually to me is a sign of a developing market rather than an immature market, because in the futures world, typically you trade 10 or 50 times the underlying supply on a daily basis in something like soybeans or gold or even stocks or bonds. Yeah. So that's actually a good thing. I'm going to say one more thing that I think is on a probability basis is likely to be wrong, but if it's true, it's really important. And that is, the answer to your question is, it's not when will it happen, when will the institutions come in, it's already happening. And by that I mean, the #1 cryptocurrency is up 250%. I don't think it's a coincidence that this is occurring the same year that we all first heard about modern monetary theory, which again is just basically printing money because it doesn't matter if you print money. Of course, we know what happens when you print too much of anything. The value goes down. And the second thing is we've seen China crack down on the other use case of Bitcoin that it was designed for, which is asset transfer, and to have your assets essentially anywhere you are versus having to carry it in a suitcase full of gold, which gets pretty heavy if you've got 9 digits, let's say, to move around. They won't let you on the plane. So I'd like to propose that the institutions are already coming in, they're being quiet about it, and this is just the beginning of what's going to happen when the second wave of institutions, not the Harvards and the Stanfords and the Chinese whales who want to move their money out but can't any other way, and the people in Venezuela who are mining, and the people in Iran who want to get their wealth out because that government's terrible there too. But the next wave, which is 10 or 100 times the size, where does Bitcoin go then? And I think I want to point out these beautiful Bitcoin socks over here. I think this is the Bitcoin maximalist side, and I think you guys are going to participate in that as well.
So I want to do a speed round, speaking on that last point, since we only have a couple minutes left. We talked a lot about Bitcoin. We talked a little bit about stable coins and digital securities. So I think we covered most of the bases that we said we wanted to cover to kind of set the stage for the rest of the day. I want to name an asset. And this, again, informational entertainment purposes only, not investment advice. When I raise my hand, it's going to be investment advice. No, I'm totally kidding. If anyone sues me, my Twitter handle is @2BitIdiot, so it's kind of on you for taking advice. But speed round with the more intelligent counterparts on the stage. Ether, buy or sell?
Very short-term buy, long-term, a lot of question marks.
I'm of the same opinion.
Yeah, I would have to. I mean, you phrase it.
Maybe we'll just keep it even easier. Pay attention to it or not, if you feel uncomfortable saying buy or sell. Litecoin.
It's going to be the low-cost alternative. It's going to be these things are like cars and airplanes versus helicopters and drone single-person vehicles and gliders. The main interest is going to be in the liquid winners, and that essentially is Bitcoin at this point, and for smart contracts, probably Ether, maybe EOS, maybe Stellar, something like that, in my opinion. So I would say it gets very concentrated at the top, but there will be use cases for helicopters. The times you need to fly in a helicopter. I try to reduce that to 0, but others need it. That's what Litecoin is. If you want a low-priced coin that's a little bit faster than Bitcoin, that's for you. But it doesn't really solve a problem.
Litecoin you should pay attention to because it's a highly manipulable crypto asset, and it single-handedly led us out of the bear market starting on February 8th when Litecoin ripped 30% in a day. And if you look back with a couple months of hindsight now, it's very clear that everything changed with the crypto markets on that day. So if for no other reason than the fact that there's 80 wallets in the world that hold at least $10 million worth of LTC, which is a pretty small Telegram chat if you want to make the price do a certain thing. So shout out to Charlie Lee.
This is speed round, so I'll just say neutral.
How about XRP, the institutional standard? I'm sorry, we're out of time.
Well done, sir.